Very happy to welcome back to Forward Guidance Stephen Kelly, Associate Director of Research at the Yale Program on Financial Stability. Stephen, great to have you back. How are you doing?
Good, great to be here. February seems like a million years ago.
It really was a billion years ago. So, Stephen, we're recording July 11th, and we just have had a soft release of the new bank regulations, the bank capital standards. Federal Reserve Michael Barr, put out a speech where he described what the new capital requirements are going to be for the bank. So, just in really broad strokes, could you describe what the new capital requirements are for banks and how effective do you think they might be in preventing the next Silicon Valley Bank failure?
I think the important context here is Vice Chair Barr started this review basically when he came into office into the Vice Chair for Supervision position in 2022. So there is some sort of pre-SVB, pre-March 2023 context to this. And I think that comes out at a few places in the proposal, or again, like you said, the preview of the proposal we sort of have the proposal to propose in a Michael Barr speech on July 10th. The biggest one being that really the 8 GSIBs, the 8 largest banks, were not, given any special treatment relative to other large banks. So we sort of talked about 2023 as a crisis of sort of this mid, sort of the banks below the biggest banks, right? The biggest banks sort of played the white knight role, the rescue role, particularly JP Morgan. They made a large deposit in First Republic to buy it a few more weeks. JP Morgan ends up buying it. So we've sort of talked about the big banks as being stable and having a stronger business model. But really, they were not exempted from this. And I think that fits Barr's priors of what needed to be done to the banking system, to capital rules, as well as any analysis he did sort of before 2023. So he really mentioned some changes to basically not letting banks use their internal models as much, tightening up stress testing. He wants to tweak the way the GSIB surcharge is calculated. But he comes out with a number and says basically we're talking about 2 percentage points of capital increase for the largest banks, which he identifies as $100 billion in assets and bigger. So this was certainly, I don't know if it's an opening bid and we'll see it get softened and watered down, but certainly this was a strong sort of warning shot or opening shot from Vice Chair Barr.
Right. And he was talking about the beauty of capital is that how it can absorb losses. And whenever someone from the Federal Reserve talks about how beautiful capital is, something's been going on in the financial system or in the banking system. So there's capital that banks hold against losses. So if a loan goes bad or they lose money, that can absorb the loss rather than the depositors taking the loss or the Federal Deposit Insurance Corporation having to pay up. So, and then a GSIB is the globally systemically important bank. So very, very large banks. Perhaps you can tell us what the sort of threshold is. So that it's 2% extra capital for the very largest banks, which may mean 100 billion. And what is that up from? And also, is this risk-weighted based capital, as opposed to a total leverage ratio?
Yeah, so this is risk-weighted based capital up from, the numbers depend on banks' results in the stress test. So you sort of have, a minimum capital level of 4.5%. You'll have a GSIB surcharge if you're a GSIB. You have a minimum buffer on top of that of 2.5%, plus basically any results of your stress test that are worse than that. So it depends on the bank, but it could be 13, 14, 15% of capital or risk-weighted assets. And so this is going to top that off. Another piece is there are non-risk-weighted ratios. Basically, this is meant to be a backstop. So, risk weights are man-made, basically. We decide how to risk-weight assets. You can see the mistakes we've made in the past, right? A AAA subprime MBS seems like something you should rate, pretty highly as AAA. But sometimes we get it wrong. So we have these backup capital ratios to say, like, okay, let's just look at all the assets. Let's not weight them at all. And let's just say, how much capital do you have against all your assets? Sometimes in the case of what's called the supplementary leverage ratio or the enhanced supplementary leverage ratio, in the case of the biggest banks, we say let's include even your off balance sheet assets, so your derivative exposures and things you may that were previously hidden off balance sheet. Let's get all that into one calculation and look at your capital against it. And one particularly notable thing from Barr's speech was that he is not going to amend this ESLR for the biggest banks, and there was a big expectation that there was going to be
Sorry,
sort of
sorry, Steven. So I don't know what the E stands for, but SLR is supplementary leverage
yeah.
ratio,
So
and
the
that's
E is just
basically
enhanced, and that's just for the biggest banks. The biggest banks have to hold. So the SLR is 3% capital to assets, all assets, non-risk weighted. ESLR is 5% for GSIBs. So they have a higher threshold to meet, and actually their depository has to hold 6%, but at the holding company level they have to hold 5%. And the what was expected or what was hoped for, I think, was that in doing this calculation, the Fed would exclude reserves at the Fed, because it's sort of goofy to include reserves at the Fed, which are infinitely liquid and have zero credit risk, in some sort of calculation of capital. And the problem with it is, you could build it into the calculation, but the problem is this number changes a lot when you have a crisis, right? When the Fed does QE and it shoves trillions and trillions of dollars of reserves into the banking system, banks' leverage goes up, even though it's the safest asset in the world with literally no liquidity or capital risk. So you don't have to be soft on that ratio. You can go from 5% to 7% or whatever you want to do, but you carve out reserves. And I think that was expected as part of maybe as a carrot to the rest of these changes. And Barr said he had no interest in it, and he sort of mentioned like, okay, we'll wait and see if the Treasury market breaks again, like it did in 2020, when the Fed basically gave an exemption to this rule. And he sort of said, all right, well, we'll keep watching the Treasury market, and if something happens, we'll reconsider, but I'm not going to make any changes. So he really came out tough. And there's a number of things in here that really come out tough. And like I said, it's 2 percentage points of capital. And just to go back to your sort of definition of capital, Jack, I think it's worth noting. We talk about capital as like it's a way that banks fund themselves, right? So it's available to take losses before the depositors take losses. It's equity funding. It's meant to represent that banks are risky, and that's all true. And like you said, Barr says capital is beautiful. He really talks about how this is just a different kind of way for banks to fund themselves. It shouldn't be thought of, necessarily as some sort of a thing other than that. But the important thing to remember is, a couple of things here. I mean, banks create deposits when they make loans, right? And when you make a loan overnight, you create a deposit. So if I take my deposit from one bank, if I take my deposit from JP Morgan and bring it over to Citigroup, I've just increased Citigroup's leverage, right? I mean, I gave them more deposits. So if they take it from me, their leverage goes up. And that's sort of an inconvenient truth for folks who want really high capital levels, because you can think about, oh, you have a crisis in the Treasury market. You have a crisis in small businesses during COVID. They need a lot of loans all of a sudden. Well, when you issue those loans, you create the deposit on the liability side, and your leverage goes up. So it's really hard. You can't fund the marginal loan, the marginal intervention with capital. You can raise capital over time, and you can retain your earnings, and that all builds into your equity. But in the short term, it's important that capital is flexible, and capital is just a really scarce resource. So sometimes it just gets mischaracterized as, oh, it's just a different way for banks to fund themselves. But you can't be a bank that's exclusively capital, because you have no deposits then. So it gets tricky. The higher and higher you take the requirements, if you don't build in the flexibility, it's harder for banks to be banks when you sort of raise and raise and raise capital requirements.
yes, and so banks create deposits when they make loans, and that is an accurate description of the technicals of banks. However, banks need capital because they're required to have capital either from governments or from depositors who just want a little bit of protection. And I don't I don't think bankers think of, oh yeah, don't deposits are leaving our bank, but it's no problem because we can just make loans. Like if they make loans to people, then those deposits will leave as well, and then their capitals gets even worse, right?
Yeah, that's absolutely true. So what we're really talking about here is at the margin. If you want to expand and grow your balance sheet, certainly a bank that's bleeding deposits is going to be worried about that and not in a hurry to make more loans. Uh, but it's at the margin. This ability to intervene and step in the way we want banks to do can be limited by capital rules and leverage rules, which sort of limit their ability to lever up. So the point just being that you can write a capital story that sort of works over time, right? So retain some more capital, raise equity. But if a market breaks today, and you want Goldman Sachs to put a floor under the market because it can do that faster than the Fed, or you want Morgan Stanley to, or whomever, it's not going to be able to raise equity by tomorrow, right? It's not like it can just choose to fund itself overnight with equity. You got to do a capital raise. You got to wait a few quarters to retain some earnings, right? So that's a whole process, and so that's where the distinction becomes important. That this is not just a different way to fund yourselves. I mean, the main thing that we rely on banks for is to give us deposit services, is to be a place for our money, right? So to think about the funding side as sort of a secondary effect of the lending side is I think not correct. Before anybody wants a loan, they want a place to store their checking account. Um, so and that's what happens when the bank makes a loan, right? If they write you a mortgage, they create a checking account for you, put the money in it. So um, it's sort of the sequence of events sort of gets reversed sometimes.
All right, so there are two types of capital requirements. One is risk based, and the other is non risk based. So I think the main one, common equity tier one, that's like if you have a fleet of vehicles and the government requires you to buy insurance on vehicles, which actually, in reality, they do, or liabilities insurance. If you have, a motorbike that's in disrepair, you're probably going to have, it's a little bit more risky than, let's say, a purely autonomous fleet that never gets in an accident, right? So they say, oh, you don't have to hold that much, insurance or capital against your autonomous fleet, but if you're going to ride your motorbike, you're going to have to take a ridiculous amount of insurance, and that is appropriate. So a lot of credit products, banks have to hold an enormous amount of capital against very risky loans because the regulators learned their lesson from 2008, and that makes a lot of sense. However, there are in the risk weighted model, the autonomous fleets are basically the equivalent of risk-free stuff like treasuries and agency mortgage-backed securities, not private label, but agency mortgage-backed securities. And I don't know if this is true, but I think that at the time it was accurate that the risk weighting for treasuries was literally 0%. And for agency mortgage-backed securities, I think it was 20%, which is quite low. And the last year, we've seen a lot of autonomous vehicle accidents. Let's put it that way, because interest rates went up from 0% to 5%, and if you had a 10-year Treasury, I don't know what you're down, 15% on an agency mortgage-backed security, you're down in some cases over 20%. So what is a quote risk-free security is not risk-free. Of course, very little credit risk, but there is interest rate risk, as everyone knows. So the first risk weighting did not require banks to hold a lot of capital, or in the case of treasuries, I think any capital against those assets. But then total leverage is like ignore any risk weighting. We're just looking at the total leverage of the bank, and that's what the supplementary leverage ratio is. So they're not raising the supplementary leverage ratio. They are raising the risk weighting one, but are they changing the definitions of risk weighting? Or are they say, hey, actually, maybe these autonomous vehicles, maybe we're seeing pileups on the interstate. Maybe it's time to actually require drivers to hold some insurance against this. Are they saying, hey, let's take it to 10% or 30% of capital, or no?
So not on the autonomous vehicles. They're definitely they're having banks sort of reconsider and standardize in some cases how they're accounting for their specific assets, their trading assets, and things like that, and having banks rely less on their own models. So to keep with your analogy, You have a Ferrari dealership and a Corvette dealership. Uh, Previously, the Fed was more willing to let the Corvette dealership say this is how risky a Corvette is, and the Ferrari dealership say this is how risky a Ferrari is. And Barr wants to come in and standardize that where it's really not modelable, or not reliable models, anyways. And the idea internationally is, let's put a floor under this. So okay, you can model some of your own risk, but if the number you come up with falls below this number, you got to impose the floor. With respect to the autonomous fleet, we're not seeing any changes, and we probably never will see any changes to risk weights to treasuries. The system's sort of built around at least the idea that treasuries are safe. So that's part of why the debt ceiling standoff stuff makes us so uncomfortable, because it sort of threatens to reveal some truth that maybe we don't want to acknowledge, or that the whole system is built around not being true. And your point about what we've seen in treasuries over the recent few years, in both directions, it is exactly distinct from reserves, which have no price or credit risk. Right, the price of a dollar on deposit at the Fed does not change with interest rates, and that's part of why that really could easily be carved out from the calculation. Um, some banks have argued that treasuries should be too. They said, look, we'll intervene, we'll support the treasury market a lot more if you don't count treasuries in even our non-risk weighted ratios. I mean, you guys are going to pay them back, right? So why are we even including this in our capital ratio?
And Stephen, there was a time when treasury rating was literally zero. In sometime in 2020, did they change it back to it's a low number but not zero anymore?
No. The risk weight is zero. It was in 2020. It was exempted from the non-risk weight calculation, the SLR.
Oh, okay, yeah.
Basically because the treasury market was going haywire during COVID. So it was exempted for a year. They said treasuries and reserves. That expired after a year. I think it's reasonable to reconsider reserves because of what I've been saying about them. But some banks have even pushed, like, okay, keep treasuries exempt forever too. If you want us to step in, they're credit risk free, right? The Fed's behind them, right? I mean, the Fed's going to step in if the market goes haywire, right. So, but you can see the argument, and SVB sort of paints that picture of, like, you don't want a bank to essentially be a levered up treasury hedge fund, not holding any capital against that. It's different than reserves at the central bank.
Got it. And in retrospect, holding a lot of treasuries and agency mortgage-backed securities with very little interest rate hedges, uh, doing so is very risky at a period when interest rates go from 0% to 5%. But I guess, it only will be as bad again if interest rates go from 5% to 10%, which, in my personal opinion, doesn't seem super likely, at least over the next year. What so they don't really make any changes on interest rate risk, right? And yeah, can you speak to how you perceive interest rate risk within the banking system, and perhaps what the recent rule changes suggest about how the Federal Reserve sees them?
Yeah, so there's really not it's not really written into the capital rules to talk about interest rate risk. Um, we can talk about hedging, and this has really gotten a lot of congressional furor because there's sort of this story about how SVB had some interest rate hedges in 2021, and they progressively dropped them over 2022. And so this has basically been characterized as a bet that interest rates were going to come down. The SVB was going to be able to cash in on basically some naked interest rate exposure. And of course, that didn't happen, right? Rates went higher and higher. Fed is still going higher, and SVB doesn't exist anymore. So that's true. It's also not really, to a first approximation, what affected SVB, or nor is it a contrast with any banking competitors. So broadly speaking, hedging interest rate risk in the way we talk about it, like with literal hedges, is not a description, not really a true description of the banking system. We talk about SVB's hedges in 2021. They hedged 12% of their interest rate risk. That's 88% unhedged. And if you look at the banking system as a whole, particularly with respect to swaps. I mean, that's where most of the research has been done, because that's the one that leaves banks without liquidity risk. If you put on hedges in the futures market or elsewhere, you can really get pinched in the short term with collateral calls and things like that. Swaps, in theory, you've hedged your liquidity risk, but anyways, if you look at the data, banks aren't really hedging away their interest rate risk. In fact, banks are sort of where we rely on interest rate risk to live. That being said, we're talking about interest rate risk like it's talked about in textbooks, which is this idea that, okay, if you borrow short and lend long, you're exposed to some interest rate risk in the interim. So that's exactly banks, right? You have short term deposits, and you buy long term assets. So if the yield goes up on your short term borrowing, you get squeezed on your long term assets, which don't change because they have a fixed interest rate. So that's true in like a hedge fundy sense. It's not really true of banks. Uh, Banks hedge by basically taking care of their depositors. So to the when rates go up, we don't all go change our bank accounts. When rates go up 100 basis points, we don't see any difference in our checking account. We see probably nothing in our savings account at that point too. And we don't rush to change that necessarily because banks offer us services, and we keep our money with our banker. We have various payments that come out of our accounts and things like that. They have some fancy app, or we're doing this and that, or money management, whatever else it may be. So that's sort of banks hedge. If you maintain the deposit franchise, if you take care of your depositors, you don't get squeezed on that funding, and you're not paying out purely with interest rates, right? You part of the service you provide is non-monetary.
And then you make more on the loans, on the new loans that you make.
Right, exactly. Or you write out your fixed yield assets, and as they mature, you put more money, like you said, into new loans. And that's sort of the business of how banks hedge. In my most recent piece, I sort of give an analogy of a corn producer, and you can think about if a corn producer goes out and buys a bunch of short futures contracts because they're going to sell their corn, into the market, and they want to lock in the price. Financially speaking, they have one contract, right? They have an exposed futures position, and they have a bunch of corn in the ground. I mean, they don't have any. They're not hedged from a financial perspective, but they're hedged because they have this literal product. But if they don't tend to their field, if they ignore their corn, if they ignore their production, and at the time of the maturity of the futures contract, they have a bunch of low quality corn they can't sell. All of a sudden, they have a huge financial position. The same is true of a bank, right? So you're hedged by taking care of your deposits, tending to your deposit franchise. If you don't take care of it and your depositors run or walk, all of a sudden you have a huge exposed financial position on the asset side. And so that's really the same story. So asking banks to put on hedges is really double hedging if they're taking care of their depositors.
Right. And on your Substack, Without Warning, you reference a paper citing that only 6% of aggregate assets in the US banking system are hedged by interest rate swaps. And that's just a question: what are you hedging? Are you hedging the securities are you hedging the loans? Are you hedging both? Are you hedging only in the available for sale? Are you hedging them only in the held to maturity category as well? I think it's common bank practice to explicitly not hedge held to maturity assets. And Silicon Valley, I think, had over 200 billion in the held to maturity category, by the way. And then it's so important that the notion that banks borrow short and lend long is not really true, because the banks have the option to you have the option to withdraw money from your bank on a callable CD, but we callable demand deposit, but you don't actually, like, I mean, there are bank deposits right now that have been there for 50 years. So the weighted average life of banks is not one day. Just because it has the option of being one day does not mean it's one day. So if bank deposits stay at the bank and pay a very low amount, then the bank can have a natural hedge by, as you say, just earning the higher yields on the new loans that it makes. So the real hedge is based for banks is the assumption of like the weighted average deposit life, and then that in combination with the deposit beta, how much banks are going to have to increase deposit costs for every 100 basis points increase in rates for the risk-free rate of treasuries. And what are those assumptions, and how much does the reality differ from those assumptions? Like the notion that banks are hedging their assets with swaps is just not accurate. If you look at even the large regional, even the large GSIB banks, they have huge swap positions on, but they're not hedging their held to maturity securities or loan portfolio because it's held to maturity. They don't do that at all. Is what I said reasonably accurate?
Yeah, yeah, absolutely. And you can look at, like, take First Republic. Part of the story that's being told about First Republic is, look, they had this loan book and the yield is 3.7%, but they had to go to the FHLB, the Federal Home Loan Bank system. They had to go to the Fed and borrow at 5%. To the extent you lose depositors, you're going to market, you're going to the repo market, the Fed funds market, commercial paper market, and paying 5%. You can see you don't have a profitable bank at that point. But it was bought out by J.P. Morgan. J.P. Morgan is not paying more than 3.7% on its deposits. I mean, straight up. So that's the story of, if you have a bank, like if First Republic didn't have a run, it has no solvency issue. Like its depositors were accepting less than 1%. It was yielding 3.7%. That's a solid net interest margin. And yeah, market rates are 5%, but who's that for? I mean, that had very little bearing on First Republic's business. But once the run showed up, you can see how the problem would occur. But again, now these assets live inside JP Morgan. JP Morgan's not paying 5% on its liabilities. It has an amazing deposit franchise that yields next to nothing. So the story of that this is a straightforward interest rate risk story is just not accurate. I mean, these aren't market funded market assets. It's a deposit franchise, and
It's about the deposits, but that is part of the interest rate risk management duration. And I guess it's just sort of what words you're using there.
yeah, and the way I think about interest rate risk with 2023 is, again, not, I don't think this textbook definition of how you'd apply it to a hedge fund is useful.
Not at all.
But the interest rate risk that existed with SVB, Signature, First Republic, all these banks that sort of got swept up, PacWest, et cetera, is not in the price of their liabilities. So we're talking about it like, okay, yields went to 5%, you see the problems, but that's not really what happened. The issue is in the quantity of their liabilities. So what happened was, I mean, what sparked this whole thing was an 8K filing by SVB. They said, look, our cash burn from our depositors is way higher than we expected. And so that, to me, is the real interest rate risk of this story. You have, in SVB's case, Silicon Valley as your depositors. In Signature's case, you bet too much of the franchise on crypto. These are interest rate sensitive sectors. So to me, that's the real interest rate risk here, is you've sort of bet your senior liabilities, namely your deposit franchise, on really interest rate sensitive sectors. And you could see how that story gets short circuited when the Fed goes from 0 to 5% in a year. It's like if you were exclusively funding loans, from oil producers, and oil goes from $100 to $20 in a year, right? I mean, the deposits are just going to get run down, and you're going to get squeezed on your liability side, have to go to market, have to pay the new rates, the new higher rates, and the bank's over at that point. So to me, that's the real interest rate risk, is in the clientele, in the industry focus, in the regional focus, in each of these cases. And that's sort of why we saw which banks we saw get really squeezed and put under pressure by this. Citigroup had $30 billion of unrealized losses, but they're never going to realize that because they have a deposit franchise. Though that marking to market is based on market rates that they're not going to pay. So it's just a different story. And to me, that's the real interest rate risk, is on the quantity of liabilities more than the price.
Absolutely. You said Citigroup had 30 billion. I think Bank of America has over 100 billion of unrealized losses on their securities book for held to maturity, and they make so much money just on paying their depositors zero for the case of individual depositors, and then making loans at higher things that they can afford that. And I mean, if Bank of America goes down, we're gonna have we're gonna be talking a lot, Stephen.
Right, right, and that's, I mean, that was another piece
To be clear,
that
obviously, I don't think that's going to happen, but you go ahead.
right, right, that was always in the background of this story is if you want to worry about basically unrealized losses on treasury securities taking down the system, you have to tell a story where the Fed doesn't cut interest rates as we start to worry about the Bank of Americas and JP Morgans of the world. Because if you have a crisis, if you have a systemic financial crisis because treasury securities are yielding too much, I mean, the Fed has to literally be asleep. You can cut rates, recapitalize the whole system. Obviously, the Fed doesn't want to do that while inflation is still high. But if you're living in a world where Bank of America, JP Morgan, Citigroup, where these banks are in trouble because of unrealized losses on treasury security or on all securities just because of the Fed's rate, if it's not credit risk, it's just about rates. The Fed has a nuclear option. And if you're worried about those big banks, inflation is no longer a concern when you're looking down the barrel of a financial crisis. So that was always sort of in the background of this. SVB wasn't important enough in itself, but if you're talking about the system going down, the Fed's going to cut interest rates. And in this situation where the losses were so driven by just interest rates, it wasn't toxic, uncertain credit assets, whatever. The Fed has a really easy solution to that it did not have in the GFC and COVID, to just cut the Fed funds rate.
Sorry to interrupt. Wanted to let you know about Blockworks' upcoming crypto event, Permissionless 2. This ultimate DeFi gathering will be taking place in Austin on the 11th to the 13th of September 2023. It will feature the very best discussions on ZK tech, rollups, account abstraction, MEV, and much, much more. All the big hitters in crypto are going to be there, so if you're into crypto, you need to be there too. To get a 20% discount to a full 3-day pass to Permissionless 2, click the link in the description and use code GUIDANCE20. That's GUIDANCE20. Thanks, and let's get back to the episode.
If there's no bank run, and really if deposits aren't leaving the bank at all, let's say the large bank, JP Morgan, which by the way, JP Morgan did an exquisite job of, quote, hedging their interest rate risk. And the reason how they hedged that is by not taking a lot of interest rate risk in the first place, not by buying agency mortgage-backed securities and then entering in some huge swap position. I think their duration of their held to maturity securities was, a lot quite low, definitely single digits. Anyway, is there any way you see unrealized losses at large banks becoming a problem in the absence of bank runs from them? And obviously, this is a tail risk scenario.
Yeah, I really don't. And, I think it's important to remember, too, that really it wasn't a problem for the banks that failed until we saw this deposit attrition. So, I've sort of been yelling till I'm blue in the face that the story that it's unrealized bond losses that set off SVB is just not true. It's a classic thing that happens in bank crises where you have a crisis and you go back and look at the balance sheet and you go, what went wrong? And if that's not what happened in real time, that's not what you can do ex post. And the reason I say that is SVB was reporting these bond losses very publicly for quarters and quarters, and the loss was actually falling.
How is the loss falling? As well,
so between the loss on their bond portfolio peaked in Q3 of 2022, and it was actually lower in Q4 of 2022, which they reported in February of this year. And after that, their stock traded at $280 for weeks and weeks. So the idea there is like, okay, in theory, well, not in theory, equity investors have for sure read the 10K. They're valuing this bank at $280 a share. And it's not until SVB goes out secretly and says, look, we need to raise capital. We need to sell these assets. We're getting way bigger runoff on the deposit side than we've expected, than we've previously forecast, that suddenly, there's a problem in nobody wants to recapitalize the business at that point. stock price goes to zero. That's an important part of the story is, can you recapitalize the business? So we can talk about, like, losses at Bank of America, for instance. Let's say the losses at Bank of America were even bigger. Let's say they were the exact size of their equity, which is roughly, what the situation is at SVB. Someone's going to come along and capitalize Bank of America, right? That's a great business. They'll get some capital from Warren Buffett or from somebody who wants to come along and equitize the business. The same
Again, this would be very bad for the stock price. I mean, I think it's what happened to Citigroup in 2008, 2009. If you have to, the time at which you need equity funding is when your stock price is in the tank. And
Sure.
so you really don't have a lot of control. So very bad for stockholders, but you're reminding you of your title. You're at the Yale Financial Program for Financial Stability. You're thinking about still financial stability, not equity investors in stocks.
Right. So yeah, that's exactly right, Jack. I mean, the 2008 story. I mean, Warren Buffett comes along and makes an investment in Goldman, and yeah, like, stockholders are not making out great at that time, but the business survives, and that's a huge endorsement. And you can look at the same story with Credit Suisse, right? Credit Suisse is basically dragging along its stock price $4, $3, whatever, for months and months from October until it fails ultimately in March. And what sets off the final, what's the final death knell in March? Well, its biggest shareholder, the last one who was putting capital in, goes on the news and says absolutely not when asked if he would ever put in more capital in Credit Suisse. And like that, the business goes away. So it kind of goes back to our discussion of capital. If you have no one willing to equitize the business, to put in new capital, no one wants to do business with the bank, and the bank is over. And that's really the story of SVB. And then you look, you can draw the line from SVB to banks that had similar problems on the liability side, namely Signature, and then First Republic, which had a lot of the same clientele as SVB. And then you start to worry about PacWest, all these other West Coast banks. But Signature had next to nothing with respect to unrealized losses. So you really can't just tell the story of looking at the balance sheet after the fact and going, oh, it was these unrealized losses, which were bad, but they were widely known. But the business still looks solid. And if the business is still solid, you can raise new equity. And it wasn't until SVB came out and said, look, our business is worse than we expected, that the crisis gets set off. And then investors go, okay, what other businesses are worse than we expected? Well, Signature has a big crypto book. That's probably, that's been running off since FTX. First Republic has a lot of the same clients, Silicon Valley. That's not good in a world where the Fed takes interest rates to 5%. And that's sort of the crisis that we saw, which really never spread to Wall Street. We were never talking about Morgan Stanley, Goldman, JP Morgan. We just never were. It was never that feeling of, we're worried that one of these banks is going to go down.
Right. The Silicon Valley Bank's huge unrealized losses did not directly cause its failure. The bank run on Silicon Valley Bank directly caused its failure. However, I would say that the bank run was caused, I think it was a Wednesday, when Goldman Sachs, its advisor, put out a thing, we're trying to raise new equity because we have all these losses. And then that's when the fear set in.
Yeah, so it was new equity because they're facing this cash burn. I mean, so they were going to sell their portfolio, their available for sale portfolio. They were going to raise new equity. And this was prompted by, higher than basically a runoff in their liabilities, and sort of, the need for new funding. And you're right. I mean, the unrealized bond losses don't help. If they were sitting on a $100 billion gain, a $20 billion gain instead of a $18 billion loss, whatever, $17 billion, equity investors might have been more enticed. You have a slightly better looking balance sheet. But again, it's, do you want to be the marginal equity investor in a bank that's, exclusively banking Silicon Valley in a world where Fed is taking interest rates to 6%, cash is running down, the payoff in this bank, sort of the cash inflows to this bank are based on new rounds of venture funding.
And not all, but a lot of the companies who are venture funded, because they're early companies, are not profitable companies. So they have a natural burn rate. So the money is going down unless there are new inflows, which inflows were very hard to come by.
Right. I mean, they're dependent on the equity market. I mean, this is venture equity, and new inflows were based on, equity investors putting in new money. And, if you tie the health of a bank's deposits to the equity market, you can see how they're the first to go when rates start moving up, right? I mean,
Yeah, yeah. I know they had sold a lot of their available for sale securities at a loss. I may speculate now, and I can go up and check that they did that to raise cash so that they could, replace their cash. But as they sold that at a loss, they realized those losses, so that was damaged their capital, which maybe that's why. But Steve, so that's a great transition to this new potential regulation. I think for banks 100 billion and above, it would require them to include available for sale losses in capital,
mhm,
not held to maturity, interestingly, but
mhm.
available for sale in losses. And my question for you uh, isn't it really all about the deposits? I mean, you said, let's say that Bank of America's equity was entirely wiped out by the unrealized losses on their securities books. The reality is that it would be wiped out in reality, but in accounting land, held to maturity doesn't matter at all, right? Isn't it true that even for the largest banks, the GSIBs, held to maturity losses don't matter for bank capital, and that's why Silicon Valley Bank could put out a chart saying that their capital ratio, and it's in the Fed bars report, which I think came out in May. Well at the end of the report, and we could put it on screen that they were in compliance with capital laws.
You're exactly right, Jack. I mean, the way we do capital ratios now is really like we were discussing before. It's how much capital do you have against risk weighted assets or assets in general. It's not let's think about your business model and is it sustainable in this environment, or let's think about your governance. If we want to talk about Credit Suisse, like problem after problem after problem in the headlines, does that force the bank to raise more capital? No, its capital ratios look great. Its liquidity ratios look great. Its capital ratios were more or less identical to UBS's. I mean, that should tell you how not fully informative these capital ratios are, and it really can't be fully offset with the accounting. Um, Certainly, in the cases we saw, for all intents and purposes, the whole banking system has unrealized losses on available for sale securities. So if you make the banks who have currently opted out, they were given sort of an opt out option from available for sale securities gains and losses, including that in their regulatory capital. It's still in their GAAP capital, but in their regulatory capital, that some were allowed to opt out, which has its downsides when you have a bunch of gains because you don't get to include it in your capital, but it has its upsides when you have a bunch of losses because you don't have to include those losses in your capital. So certainly, if we said you have to include that, that makes the banking system, better capitalized at the margin. And yeah, we can. There's been a lot of discussion now too of, well, let's include held to maturity securities and let's make them hold regulatory capital against that. And so, I mean, there's two things. Like you said, held to maturity capital is not even included in GAAP accounting. Those gains and loss, the unrealized losses are not even included in GAAP accounting. Banks can totally ignore them. So you go, fine, but why? Because you look at a crisis and you look at SVB's case and you go, how the heck are they allowed to just exclude, $17 billion from their capital? Like, what an accounting fiction, right? But it goes back to that discussion we had before of, let's say you're Citigroup. Why should you have to include those unrealized losses, which are based on marking your assets to essentially the treasury yield curve, marking them to 5% yields when you're paying 1%? Shouldn't you have to mark them to your deposit curve or not at all? So that's again the question of like the accounting that made sense for SVB. Obviously, in hindsight, like, okay, they should have had way more capital, SVB, because they were running this really risky business that was really sensitive to interest rates and the tech economy. Wouldn't have made sense for Bank of America because of exactly what we were saying before. They're still paying zero. Why should they have to mark their assets to 5% and include that all in their capital? Do we really want Bank of America to go out and raise $10 billion, $20 billion in more capital just because of accounting losses?
Well, Stephen, they could include the losses on the unrealized securities in the held to maturity portfolio, but then also book a gain on the spread between their deposit costs and the risk-free rate. In other words, you know what I'm saying? Like with the fact that their net interest income increases, they could say, oh, actually our equity is worth more, or we're booking this gain because we're making so much money in the future.
Yeah, so it becomes a question of how do you mark the assets to market? Because right now we go, okay, you have an observable treasury price. So let's say you're Bank of America, you have some treasury, you have a 20% loss. That's observable on the Bloomberg screen, and that's what you have to report. So yes, we're saying here, like, okay, but really they're not paying, they're not paying the 5%. So that's what's gets so wonky about this is if you want them to mark their assets to market, the marking really comes from assuming a 5% yield. I mean, that's what's baked into the $100 treasury that's paying it, that's costs $80 is an assumed cost of funds over time. And what we're saying here now is banks don't really have that assumed cost. So it makes sense to not force banks to raise capital to support a bunch of held to maturity assets. So it comes back to, again, something that certainly can be done is they can do better about what's exactly held to maturity and what's not. So you can look back, and the CEO of SVB was literally in the Financial Times in like February. So before they were, really in trouble, saying, oh, we're not worried about our unrealized losses, and we have all these held to maturity securities that we can repo if we need to. And okay, it's like, is that really held to maturity if you have to take them to market and borrow against them, which again would be at that 5% rate? You're sort of realizing that interest rate risk. If you're running out of deposits and having to go borrow against them at the Fed, is that really held to maturity? I mean, technically you're holding them, but you're getting squeezed on your interest rates. So we can probably do better at those classifications. But just forcing it all through the same accounting lens is not going to solve the problem, and investors will just ignore it most of the time, because if you're reading Citigroup's 10K, it just doesn't make sense for you to read through that far.
Right. And tell us about how much money has been leaving the banking system. Where has it been going? Just to money market funds? And then at what point does that become an issue? And also, can you talk about, is it leaving from the small banks, going to the large banks and stuff like that?
Yeah. So what we've seen is basically, deposit attrition across the board since the Fed has really started tightening policy in 2022. And this makes sense mechanically for a few reasons. I mean, the Fed is literally destroying reserves with QT, letting its portfolio run off. Banks are letting loans basically mature. And like we talked about, you sort of destroy the deposit when you destroy the loan balance. And so we sort of saw a general downward trend across banks that basically sharpened in March. And in those fateful couple of weeks, we saw certain inflows into the largest banks. We kind of sort of saw flatness among community banks, and obviously sharp withdrawals in sort of that mid-tier banks. And we could talk about, exactly that system. There's been a lot of commentary from the Fed and others lately about this sort of idea of a barbell banking system. We can talk about that. But really, we sort of seen a continued march down in deposits, and it's sort of awkward, right? Because it was only a couple of years ago we were talking about banks having too many deposits, and it goes back to this issue of deposits basically creating leverage for banks. And so during COVID, a lot of banks were pushing depositors away and said, "Look, we offer money market funds. Why don't you go buy one of those? We don't have a use for your deposit," and it cranks on our leverage ratio in a way that we don't want right now. So we've sort of seen that natural attrition. So point is, some of the deposits have just straight up disappeared. Some of it has been transfers into money market funds as yields have gone up, particularly when there was concerns over the safety of certain banks in March. You sort of see a sharp strike, a sharp jump, a few $100 billion in money market funds. And so importantly, a lot of that money can find its way back to the banking system, via money market funds investing in repos, commercial paper. But again, you've taken what was a deposit and turned it into a repo or commercial paper at 5%. So things got a lot more fragile when that happened in March. And some of the money can leave the banking system by going to the Fed. And this is a new thing. I mean, historically speaking, this is new. The reverse repo facility, money market funds can take over $100 billion there every day. And then we're talking about each fund. And so really funds can exit the banking system. This was not the case, as recently as a few years ago. And for a while, the reverse repo was a real had a cap on it of much smaller amounts. The Fed has raised and raised and raised. I think it's 160 billion right now. But point being, these are actually funds that can leave the banking system in a way they couldn't. Usually reserves are going somewhere among banks, and now they can really park at the Fed. And so this has been, making people nervous that to the extent you can take reserves out of the banking system, there's a risk that they're not in the right place at the right time, and someone needs to make a payment and they don't have the money, or they need to meet a collateral call. But I think that's a big question mark right now of it's one, how much more deposit attrition can banks take? The levels seem to be leveling out a little bit. And two, how low can Fed reserves in the banking system go? Netting out what's sitting at the Fed at the reverse repo facility.
Right. So the reverse repo facility, it's now quote only 1.8 trillion, and it's down about $300 billion just over the past month or so. So or 400 billion. How do you think the decline in the reverse repo facility is that money going back into the banking system, the bank reserves?
Yeah, so this was certainly making people nervous because there's been a sort of a rebuild of the Treasury's checking account post debt ceiling. That being resolved, the Fed or the Treasury has sort of rebuilt its checking account at the Fed. So to some extent, this is not really in the banking system yet. It's sort of been a transfer from the reverse repo facility to the Treasury. But it was making people nervous that this money was going to come out of the banking system as opposed to the reverse repo facility. And you'd get, imagine that $400 billion came out of banks and went to Treasury instead of out of the Fed's reverse repo facility and went to Treasury. And then you start worrying about, okay, is there enough liquidity? Is it in the right place at the right time? So far, I think people are more relaxed seeing it come out of the reverse repo facility, which is essentially dead money. It's just an amount that sits at the Fed. The Fed is taking that out of the banking system every night. So it's sort of weird when the Fed is still doing QE because they sort of are pumping in reserves at one side and sucking them up at the short end.
Yeah, just in terms of the language, the Fed is not taking money out of the banking system. People, customers, businesses are withdrawing money from the banking system and putting it into money market funds, which own treasuries, but also invest in the reverse repo facility at the Fed. So the Federal Reserve is not doing it, willfully. It's just kind of happening because people are doing it.
Right. They're not choosing the amount in the way they choose the amount for QE and QT, right? They say $95 billion a month or whatever. The Fed is not doing that, but they are incentivizing it with, an interest rate, and they're raising the limits, which have effectively not been a limit. They used to be 5 billion and 30 billion, now it's 160 billion. And that's by fund. So if you're Fidelity, you have 1 million money market funds that can go to the Fed. So yeah, they are allowing it more so than choosing that number, like you said.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview.
Stephen, if we could zoom out, how would you assess the health of the U.S. banking system? I mean, what are the odds that another Silicon Valley Bank thing happens? What are the odds that this is a horrible cascade of really nasty insolvencies? And what are the odds that nothing really bad happens at all? Maybe a few minor bank failures, but it's all clear.
Yeah, I would say, First principles are things are stable now, but more fragile than in February. And part of it goes back to, banks are paying up a little bit for deposits. They've lost a little bit more on the deposit side. They're using more market-based funding, et cetera, et cetera. Um, and there's questions about the economy. I mean, that's another thing that really holds the banking system up is the economy has still been really strong, really low unemployment. Um,
Low credit
so
losses.
Right. So as that sort of softens, there's a lot of concern now over commercial real estate, and we can think about how that works its way through the banking system. But that's sort of the starting place of where we are. I would say the most likely risk. Again, this is not like base case, but most likely risk is really sort of more in this credit crunchy space of, we're going to have smaller banks that really do get squeezed on interest rates, and maybe close. Maybe we see more bank closures sort of at the small end, and less access to credit at the margin. We see commercial real estate really squeeze some banks, and to me, the risk here is really more of a monetary policy issue. Like it's hard to solve that with a financial stability intervention. With a rent, the way the Fed goes into the corporate bond market or something is different than how it could sort of solve a commercial real estate sort of slow burn, right? Um, so to me, that's sort of the main risk. But again, there's just not that line of contagion to the core of the system. And this is another thing that's gotten a lot of airtime post March. Basically, is we have a lot of banks in the U.S. and it's not clear we need all of them. Almost 5,000 banks, almost 5,000 credit unions. If we lose some, it's not clear that writes the crisis story. Um, so again, we continue to see really no line of contagion to the core of the system, which I think is most important. But yeah, we could see more closures of small banks, in the interim. And of course, something can always blow up that we don't see. Somebody can always file an emergency 8K or whatever. But I think this is probably more likely going to be a monetary policy issue where the Fed has to think about what's it going to do to cut rates to respond to commercial real estate or sort of general credit crunchiness versus financial stability crisis.
And do you think the Federal Reserve will cut interest rates in order
Yeah,
to?
I think they need to start being more clear about this because they really have talked about what they
Higher for
call
longer.
like separation principle. That like we have the tools to respond to financial stability fires as they come up in our tightening cycle, and that's true. And if we get a hedge fund blow up or something, they can certainly do that, and they did that in March, responding to the banks. But like I said, it's a little tougher when you're talking about the complicated and heterogeneous world of commercial real estate, and you're talking about a lot of small banks at once. At a certain point, this becomes a monetary policy issue, and they need to think about how they would be cutting rates in response to what manifests as a credit crunch, as opposed to a financial crisis. So they definitely need to start thinking about. I mean, they are thinking about it. They may need to start talking about it more and clarify when some of these more credit side risks become a monetary policy issue.
How would cutting rates help banks with commercial real estate exposure to commercial real estate loans that are defaulting or gone, people not paying back? If people aren't going to pay you back, it doesn't matter what interest rates are. You're not going to
Yeah,
pay
I
back.
mean, that's exactly right. The moment it becomes a toxic asset, the Fed's too late. I mean, to the extent that they can cut rates and ease people's repayment burden, ease valuations in the credit real estate or the commercial real estate market, that's helpful. But exactly to your point, once you're in the 2008 scenario, cutting interest rates is not going to do you any good on subprime. Once you're in COVID, cutting interest rates doesn't do you any good. So it's a hard market to intervene in, the way the Fed does, which is kind of why I made that earlier point. It's hard for the Fed to go, they can't really go up and buy up commercial real estate. They have facilities in the past that have sort of tried to include commercial real estate to very limited success, and you still sort of involve private balance sheets. And so it's a difficult thing to come in too late to. But again, it's just not tied to money markets in the way it was in 2008. I mean, so much of the real estate story of 2008 wasn't just house prices go down, it was, okay, house prices go down, and now all of a sudden we're worried about the entire repo market and the entire commercial paper market, asset-backed commercial paper market, and then you get the bank blowups. And that story really isn't there at this point. So again, that's why it's more of a slow-moving credit crunch type risk than an overnight financial crisis risk.
You're saying in 2007, 2008, banks were funding themselves by securitizing toxic subprime loans and using that as collateral to obtain loans. And then when the integrity of those loans was questioned, that drew upon their funding risks. You're saying with commercial real estate, that is not the case. Banks are not using commercial real estate to fund themselves. Is that true?
I mean, I'm sure there's some cases where banks have, secured credit against commercial real estate loans, but it's just, I mean, well, for one, the asset-backed commercial paper market really doesn't exist in the way it did before. But yeah, you don't see like this sort of AAA, private credit stuff backing money markets basically. And so it's harder to draw a line until you have a bank failure. It's hard to draw a line from commercial real estate to money markets. So, whereas in past episodes, the story was commercial real estate, money markets, bank failure. Now you'd have to go to, get a bank failure from commercial real estate and then draw the line to money markets. Is Bank of America going to fail because of their commercial real estate portfolio? No.
It's very small, I think.
Yeah, right.
The office. Yeah. So in 3 days, I think the big banks start reporting their earnings. What are you going to have your eye on?
So I'll have my eye on a discussion of deposit costs because there really has been two parts to the story, and we've sort of minimized the second part to some degree in this conversation, and I think usefully. But part of it is like you start hiking rates 5% and more, like there is some consumer awareness, and deposits aren't infinitely sticky. Like you said, if rates go to 10%. That deposit franchise is even harder to maintain. You have to have good enough, like if you want to keep rates at zero, which deposits don't need to, but you've got to have 10 percentage points worth of good service on your deposits. I mean, that is really good service. That's more than a free toaster when you open the account, right? So, there is sort of a second phase to this crisis, which is, increased awareness among depositors of higher rate options. And so I'll be watching, for banks to really talk about that. As well as any color we can get on mergers and how strong the appetite is, particularly among GSIBs and what they're hearing on mergers, because mergers are really stabilizing during financial instability, but they're also really unpopular because the big banks get bigger. And so there's sort of been mixed signals out of DC, and I'm sure analysts will be asking the CEOs on the calls, what do you like out there? Are you looking at possible acquisitions? And I'll be interested to hear responses to that.
So real quick, two things I don't think we've mentioned yet, or only briefly, is that this will also require some banks to issue more long-term debt that can absorb losses and reduce the cost of the FDIC in potential bank failures. And then also they talk about the Basel III Endgame. So what is the Basel III Endgame?
So Basel III Endgame is really a continuation of Basel III, which was like the post 2008 international accord, basically for bank regulation. So they're calling it Basel III Endgame because pieces of it still have not been implemented. Internationally, the details were worked out in like 2017. So you can build in a couple legs there. But this is really, again, goes back to some of that stuff I said earlier about standardization and how banks are allowed to use model risk. When it comes to this issuance of long-term debt, this is something that the bank regulators in the U.S. have the current crop has been interested in. I'm not super convinced of its utility relative to equity. To me, it's sometimes can appear like a little too clever by half. It's sort of a way to trick bond investors into buying equity to a certain extent. But it's just hard to bail because like equity, you don't have to actually bail in. Like when there's a crisis, you don't have to say, okay, we're writing the equity down. The equity just goes down. And so there's all sorts of contagion that can happen when you say, okay, we're going to write these bonds down or we're going to convert them to equity holders. Credit Suisse was its own kind of mess, but obviously
Yeah.
there was, a sort of a brouhaha over their credit write downs.
Not to mention, Stephen, what if that long term debt was of rated investment grade, as is frequently the case, and it was part of a investment grade ETF that pension funds hold? You can see the contagion kind of spiraling.
Right, and that's exactly right. And we saw a little bit of debt get written off in the SVB and First Republic and Signature cases, but there's a question of what happens if we had, asked them to raise a bunch more debt that was bail-inable. That would have been good, quote unquote good. But also then it's like, okay, if you're talking about a significant chunk of debt, is there more contagion there? What does that portend for other banks? Because you'll see the spreads go up, and then they got their own set of problems that they might not have had before. Um, so we'll see. Bank equity is scarce, so I get the incentive to try to source bail-inable capital where you can. But to a certain extent, sometimes you just need more equity. It's just more straightforward.
Final question, Stephen. At what level of interest rates does financial stability begin to become threatened? Right now, we're at 5.25% on the upper range. Is it 6%? Is it 7%? Is it 8%? Is there some point in the future where actually the current rate, 5.25%, poses a risk, and actually the Fed needs to cut?
Part of the story, right, is how's the economy doing? So interest rates don't exist in a vacuum. So where is the interest rate relative to the economy? And again, there's a difference between what you can call like a credit crunch or a recession versus a financial crisis. And maybe rates can go to 15% and not have a financial crisis. I don't know. We didn't really see 5% triggering SVB because again, there was all these other factors at play specific to its business model. So again, something can come up overnight where all of a sudden you need the systemic risk exception and the Fed and the FDIC, the Treasury, like happened in March. But then you look at since then, and things are calm and rates are still going up, right? So something can sort of come out of the shadows, but also the economy's strong, and that really can't be overstated how beneficial that is relative to interest rates. So if the economy weakens and the Fed keeps rates at 6%, things are going to get more and more fragile. And again, that's where it becomes a monetary policy issue.
Got it. What if the economy remains gangbusters, credit losses remain near zero, or for risky stuff like autos and credit cards, they remain within the models and lower than 2019, for example? How high can the Fed go? Is there some point at which the funding costs and the interest rate risk within the banking system, that itself is a risk, and it's not just a bad economy and credit losses?
We'd have to see some sort of precipitating event, like we saw in March, or a massive change in depositor behavior. Like I said, you take rates to 10%, people aren't going to be as happy with 0%. Maybe they live with it at 3%, but when it goes to 10%, you start looking around. So again, I can't give you a fixed number, but certainly things always get more fragile the longer and higher rates go. You sort of see what structures got built around that earlier world, and you see how sustainable they are.
Got it. Well, Stephen, people can follow you on Twitter at StephenKelly49, your Substack withoutwarningresearch.com. And tell us about the work that you do at the Yale Program on financial stability. And yeah, is there kind of a next project that you're working on that you're excited about, as well as perhaps what's the next piece on the Without Warning Substack going to be about?
So I don't know what the next piece on Without Warning is going to be. Part of the name has two genesis. One is that I never know when I'm going to write something again, so I don't have like a once a week, twice a week. It could be 5 times a month. It could be 0 times a month. And the other sort of reason for the name is that I don't really write like intro type like I don't say, oh, in March 2020, COVID, there's enough of that in more formal writing. So I sort of spare the reader. It's really targeted at a financially aware audience. So I sort of skip the intros and get right into the meat of it.
There's no third meaning of financial crises strike without warning?
No, there's not
Oh,
actually,
wow.
but it does kind of sound like that. So that was kind of the other reason. I was just like, it sounds like financial risky. So it kind of fits. There's also a few hip hop references, and I'm a big fan, so that it sort of fits in there too. Um, at the Yale Program on Financial Stability, we are sort of uniquely focused on fighting financial crises. So we're sort of built on the delightful premise that prevention is going to fail at some point, and it pays to have a non-political body that can really focus on what are the tools when a financial crisis is already here. So we have something called the New Badge Project, which is our main output, named for Walter Badgett, who has the original Badgett's dictum, lend freely at a penalty rate against good collateral. And that's a great story, and it's still accurate, but it doesn't really tell you how to end a crisis. And it's rarely enough, as we saw, just recently with Credit Suisse. You could put $200 billion in the window, and you still sort of bleed clients and funding. So we have an online platform of historical interventions and what worked and what didn't. That's sort of our main, public output. We have a huge database of financial crisis resources, past interviews we've done, and so we're always working on that. We're doing a lot of stuff, policy stuff on 2023 these days, and so we're trying to really make sure we're ready and hopefully can avoid this systemic risk exception next time around, and focus on how we fight these things when they show up without warning, I guess.
There we go. Stephen, thanks so much for joining us, sharing your insights, and thanks everyone for watching.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.